In a modern economy, money is not only printed, it is created every day by banks. When you walk into a bank and take out a loan, say $10,000, the bank doesn't give you money that someone else deposited. It creates new money by simply typing new numbers into your account. From nothing, a new deposit appears. A promise to repay becomes part of the nation's money supply. Commercial banks are factories, not of goods but of credit. Every loan is a small act of creation. And as these loans accumulate, they expand the total stock of money circulating through the economy. This process is not magic, it's trust formalized, a belief that borrowers will repay, that tomorrow's income would validate today's money. When banks lend freely, people and companies suddenly have more spending power. They buy homes, cars, equipment, and ideas. Money circulates, shops fill, growth feels strong. But when credit grows faster than the real economy's capacity to produce, demand runs ahead of supply, and prices rise. That's inflation, too much money chasing too few goods. Not all lending builds something new. Some credit goes to build new houses or factories. That's productive credit. But much of it simply chases existing assets. Second-hand homes, stocks, land. When credit flows into existing assets, it doesn't create new goods. It just beats up prices. The result, asset inflation, rising house and stock prices, without real economic growth underneath. Credit is cyclical. In the expansion phase, optimism reigns. Banks lend easily, people borrow confidently, and new money flows fast. Then inflation rises. Central banks step in, interest rates climb, borrowing slows, and the economy cools. What follows is contraction, less lending, less money creation, slower demand, sometimes even recession. Inflation and deflation are not mysterious forces. They are the pulse of the credit machine, breathing in and out through time. The central bank's balancing act. Above all stands the central bank, the quiet referee of the system. It doesn't print most of the money in circulation. It simply sets the rules of the game by raising or lowering interest rates. It makes borrowing easier or harder. Its goal is to keep just enough credit flowing to support growth, but not so much that it overheats the economy. Yet control is imperfect. Central banks can set the price of credit, not its quantity. That depends on how confident banks and borrowers feel. Money creation through lending is not just economics. It's psychology, a reflection of how much faith we have in tomorrow. When we borrow, we declare confidence in the future. When we overborrow, we express an illusion. But the future will always repay our optimism. Inflation, in this sense, is not only a rise in prices. It's the economic form of human impatience, the urge to live beyond the limits of the present. Not all credit is created equal. What truly matters is where it flows. A loan to startups feeds innovation. To manufacturing, it builds capacity and jobs. To real estate, it can create homes or bubbles. Credit for technology raises productivity for decades. Every loan is a vote for what kind of economy we want to build. Governments try to guide this flow. They offer soft loans, credit guarantees, and subsidized interest. Instruments meant to turn potential into productivity. When used wisely, they open doors for small firms and innovators. But when credit becomes too easy, it starts to inflate demand faster than supply. Growth loses balance and inflation takes the lead. Banks stand in the middle of this delicate dance. They are not just money machines, they are conductors of capital. In the end, every boom and bust every way of growth or inflation comes back to a single truth. Money is trust, multiplied through credit. This is Gavri Talk Business. Banks may create money, but we, borrowers, investors, governments, decide what the money becomes. Please like, comment, and subscribe, and see you next time.